Welcome to Dental Business RX. Practice success in 30 minutes or less.
Thank you for calling ABC Dental.
No matter where you are in the dental industry, you have some level of awareness of the moves DSOs have been making over the past at least few years. You might be one of the 10% of U.S. dentists or many dental team members employed by a DSO, or a senior in dental school, or a newer doctor who's being heavily recruited by one. Or you might be a dentist who has sold or is looking at selling to a DSO. And if you don't fall into one of these categories, there's a great chance you know at least one person that does. So with all of these connections, there's a ton of information flying around about DSOs. You know, how much they pay for practices, how long you have to stay. This one pays more than that, and so on. You know, we hear it here at MGE via our client base. There's also been a ton of articles and speculation that DSOs are going to take over the industry in various industry publications. So, of course, with MGE being a part of the dental industry, we've had to be aware of this and stay aware of it, if anything, just to provide intelligent guidance to our thousands of dentist clients. And it's with that in mind that we have this week's episode. You might have thought at some point that the future of dentistry is DSO, or are DSOs, whichever the correct way to say that is. Well, we don't think that at all. As a matter of fact, we think the exact opposite. To that end, recently, Sabri, who you've heard on various prior episodes, and I were comparing notes recently, and we both independently, sort of by doing the math, came to the same conclusion that quite a few of these DSOs might find themselves in serious trouble in the near future. And to be clear what we mean by trouble, we mean that they may be facing considerable growth and economic problems. And that's what I want to talk about in this week's episode. I also want to get into how this may affect you as an individual dentist, as well as what you can do to make the best of all of this. My name is Jeff Bloomberg, and I'm your host. And when I say DSOs are in trouble, or economic trouble, growth trouble, I don't want to generalize. You know, there's a lot of DSOs, especially now. And we first started to see DSO activity probably, 2005, 2006. It was not huge from an impact perspective. You know, a few clients sold, etc. It wasn't a lot going on. You know, they were just, and their growth model was not necessarily unsustainable. Now, the last 5 or 6 years, it got crazy. There are a lot of companies in this space now. Well, what happened? Well, what happened was big money got involved. What do we mean by big money? Private equity, hedge funds, big money got into the DSO game. You know, one of our clients who has several offices went to a conference. This was about a year ago. The conference was on how to set up your management organization if you have multiple practices. So he went just to get some tips. And I think the speaker for most of the day was an attorney. And when he came back, the first thing he remarked to me was, you know, Jeff, you know where they have the displayers, you know, all the booths outside the hall. Most of the displayers, most of the vendors at this conference were private equity, hedge funds. Those were most of the people displaying in this area. Hedge funds were super aggressive about it and super, super interested. This is where you started to see these humongous offers on practices. If you compare that to what people were being offered by DSOs, 15 years ago, not even close. So the stuff that's going on may not affect the DSOs as badly that have been in the space for some time. I do think the newer participants in this space are looking at a much rockier road going forward. And look, we may be calling this early. All right. You know, back in October, we did our 12 points or recession-proof your practice checklist in October of 2022. And it wasn't a popular thing to talk about at the time, so it didn't get a lot of traction. But now you're starting to see buzz about a potential recession in the future. It's being talked about a bit more. So we might be a bit early. And I'm not an investment advisor. You know, I'm just telling you what we see, and you have to follow your own guidance and figure out what's best for you, what works best for you, and what's most real to you. But this is definitely something that, at least from our perspective, we see coming. So now, what I want to do is I want to go over first before I get into what you should do or what we would suggest you do or what we're telling our clients to do. I want to go over the 4 reasons. You know, how do we come to this conclusion? The 4 reasons we think that some of these DSOs might be in for a rocky ride. Well, reason number 1 is money is no longer cheap. And what does that mean? Basically, interest rates have gone up. I mean, if you think about it, if you get a $100,000 loan and interest rates are 2%, well, you're not going to pay back as much as if interest rates are 10. So that money costs you more to access. Well, a lot of these private equity firms and DSOs work with a lot of debt. So how has that worked? Well, you hear about, the Fed, the Federal Reserve, raising rates. Well, what rate are they raising? It's something called the current discount rate. And again, I'm going to have some economic terminology. I'm saying it mainly because it's something that I feel would be good to know just to understand what's going on. I'm not just throwing this out there for the sake of throwing that out there. And if I throw anything out, I will define it. But it's the current discount rate. What is the current discount rate? Essentially, it's the interest rate that the Federal Reserve charges a bank when they give them money, when they loan them money. That's the interest rate we all hear about that is currently at 5.25%. So, look, I don't know the inner workings of this. It's not the most, transparent thing in the world. But essentially, according to this, if the Fed lends a bank money, the bank is going to have to pay 5.25%. So now if the bank is then going to loan you that money, they're going to have to charge you more. Otherwise, they make no money. They're just being a loan service for the Federal Reserve. That doesn't work. So how does that compare to the past? Well, that number, instead of being 5.25, was 0.25 from March of 2020 through March of 2022. That's why rates were so low. And what about the past? Well, from 2013 to 2015, that number was 0.75. So this is 10 years ago. And then from 15, or actually really more 16 through 19, it started to creep up a bit. It maxed out at 3% for just a second and then dropped to 2.25 right before COVID started. So rates were not as high as they are now. They were actually far lower. Money was cheaper. So you got that factor number one, because a lot of these organizations that were buying up all these practices, DSOs, are operating with debt or money coming from hedge funds, which operate off with a lot of debt. So now throw on top of that recent bank failures. We've heard about some of these: Signature Bank, Silicon Valley Bank, etc. Well, what happens when banks fail, if you think about it for a second, if you're on a hike and you see somebody step somewhere and they get themselves in trouble, you're not going to step there, and you're probably going to watch where you're stepping a little bit more carefully. So if you're the president of another bank and you see banks fail because, of how they were run, there was an inefficiency in how they were run, you are going to try to avoid those same inefficiencies. All right. I'm not going to get into the reasons why or whatever I could, but then I think you'd probably switch off if you haven't already. I hope you haven't. Well, so how do we know what banks' viewpoints are with relation to lending money right now? There's a survey that the Fed does. It's called the Sloop Report. Again, sorry for the terminology, but I'm going to throw it out there. Not the boat. It's not the sloop. That's a boat. It's the Federal Reserve System's Senior Loan Officer Opinion Survey, Sloop Survey. It's a survey. So they survey loan officers of domestic U.S. banks, and they ask them a series of questions, and then they graph these answers by percentages. Okay. So to give you an idea, I'll put these links on the episode webpage if you want to hit these graphs. The first graph I'll talk about is a graph of what percentage of banks are tightening lending standards for loaning to mid-size to larger firms. Okay. What percentage are tightening? There's loosening, making it easier to get money, and there's tightening, it's harder to get money. That number currently is at 46% of domestic banks are tightening their lending to medium to large size firms. Okay, 46%. Now, again, that number means nothing unless you compare it to other times. Well, that number was below zero, meaning these banks were loosening standards, or close to zero from 2010 to now. I'll say that again. So that number was at zero or below zero, meaning the banks were loosening, or close to zero, really, or below zero, which means those banks were loosening from 2010 to now. Now, you'll see on that graph, if you manage to look or you happen to look at it, there's a small blip during the beginning of COVID where the number of banks tightening went up for a month or two. But for the most part, banks were pretty loose in credit standards for about 13 years. All right. There's fallout from this with credit cards. Credit card lending was around 10 to below zero. The number of banks that were tightening standards it went up to maybe a little bit below 10% at various points over the last 13 years. And for the most part, it was below zero, meaning they were loosening credit standards up until recently. That number is now at 30%. 30% of banks are tightening credit card lending standards. And you may have seen this as a doctor, if you're in practice, with patients. You may have patients talking about interest rates. You may have patients you may not have seen the same level of approvals you were seeing for various types of patient financial instruments, 2 years ago. That's the fallout you see from it there. So just as an aside, you might go, well, okay, what do I do about that? Well, there's something to think about this in the sense of if I have $10,000 available on my credit card and you present a treatment plan to me for $7,000, if times are easy and money is essentially free, well, then that's one less thing for me to worry about when it comes to paying you for my treatment plan. Versus if rates are a bit higher, which if you don't necessarily always look at this, but especially if you don't carry a balance on a credit card, but look at the back page of your credit card statement and look at what the rate would be if you left a balance on there. If you have a balance on there, that rate has gone up a lot. So that's something where if you're asking a patient when rates are higher to pay and they're bringing that up as an objection, right now their money is a little bit more dear to them. So then all that means it's not that you have to ride it out and go for less treatment acceptance or less growth. It just means that you have to be better at selling so that the patient sees the value in what you're presenting. Interest rates have no bearing on a patient's oral health. They either have good oral health or they don't. They have a dental problem or they don't, regardless of what interest rates are. So you have to be better at communicating it to them in such a way that they see the importance of it and are willing to overcome that objection. That's really all it comes down to. That's why our clients have had no real issues during prior recessions back in the, 08, 09, whatever, because they were able to help patients overcome that with communication. So this is my only shameless plug of the episode. If you want to learn how to sell better, you can check out the MGE Communication and Sales Seminars. I'll put a link on the episode webpage. We also have sales training for professionals, okay, on our online platform, DDS Success. Again, I'll put a link on the episode webpage. All right, so you got credit tightening. You have interest rates going up, which is part of it. Some banks got themselves in trouble, which further contributed to credit tightening. Well, again, where is private equity, hedge funds? Where are they getting their money? Where are these DSOs getting their money? In a lot of cases, they're getting it from debt, or they have money and they're having to rethink where they are investing it. They're being a little bit more careful because a lot of these guys operate with debt. So I've got debt. I got to make sure that this debt really works for me, or the cash that I have to make sure it really works for me. So what are we seeing? Well, anecdotally, we've seen it with clients as well as doctors that aren't clients who are mid-process. These are recent developments of selling to DSOs where DSOs are backing out. We've seen a few deals fall through, and not because of the practice. They fell through because of funding. Okay. So we don't know if this is just the first cracks in the dam. Might be not a situation, not a problem, or this might be a trend that continues to accelerate because it's a lot harder to come by that money to buy these offices. So that's the first reason. What's the second reason that a lot of these DSOs might find themselves, with a rocky road? Is inflation. I'm going to mix up a few reasons here into one. Inflation, tons of managed care, and the fact that in a lot of these DSO offices, the profit margin is already very thin. So we've got a few things going on, and I've talked about this especially in last week's episode. I hit on this very heavily. Inflation is at 17% if you compound it over the last 3 years. 17% is our base inflation rate since March of 2020 through March of 2023. And most PPOs, if you take a look, you're ending up with a 40 or 50% write-off for a lot of your services. So even if you're a DSO, which gives you what we would call an economy of scale, if I have, 100 offices and I approach a lab, I can get a better deal than the individual practitioner. Even if I'm one of those organizations, those PPO fees, even if I can contact that PPO and negotiate a better fee, I'm not going to hit 100%. Well, there's a reason why fees are what they are. They're what you need in order to actually operate. We're already dealing with companies that have these really thin margins. So you're going to have a situation if the inflation bug keeps accelerating and a lot of PPOs have lowered reimbursement and you already have low profit margins, do the math. You can see where this is going. Then on top of that, when these DSOs buy these practices, and a lot have been acquired over the last 2-3 years, they're normally asking the doctor to stay for anywhere from 2 to 5 years. The original owner operator, which in a lot of cases, that owner operator was very responsible for overall office productivity. So they come in, they give this individual, this guy or girl, a bunch of money. Maybe they leave them with a certain percentage of the practice, and they agree as part of this sale to stick around for 4 years, 5 years, 2 years, or whatever. What happens after that time goes up? If you take a look at any dental practice, right, the fact that the owner is there makes a huge difference. And that's someone with ultimate skin in the game. That's why it's great if you're opening, a bunch of offices to have a couple of other doctors with skin in the game. It's not just employees. There's a difference in responsibility level. So, I came along and bought your practice 4 years ago. Clock's run out. You've decided to move to another state. And now I've got your practice, as the DSO running it, and you're gone. Well, who am I going to get with the same amount of intention and skin in the game that you had? I'm probably not. And this is speculation, but you may see a sag in overall productivity at that point. And then on top of that, DSOs are not built to scale practices. That isn't their business model. I'm not going to come in and buy your $50,000 a month office and scale it to doing 150. I'm going to buy your $200,000 a month office, drop some specialists in there, and hope I can get it up to 300. Maybe even join a few more plans to get more patient flow. That's their business model. They're not like the solo practitioner who goes in and booms an individual practice, right? And that's why if you listen, I don't want to keep hearkening back to too many prior episodes, but in last week's episode, I brought up, this is a great time to be a privately practicing dentist. There's going to be a ton of practices that aren't DSO targets that are going to be coming on the market. Listen to the episode. I give you the metrics right in there, which are not going to be DSO targets that are great to operate. Anyway, so that's reason number 2. Inflation, managed care, and margins are already thin. What's reason number 3? They are overpaying for practices. So what do we mean by that? Well, the traditional dental business valuation model for a long time, at least since I've been in the industry, which was the early 90s, was 70% of last year's collections. So if you went to a doctor's office who was doing $500 a year or did $500 last year, you would pay $350,000 for that practice. That was the traditional model for practice purchases. Again, if some of the equipment was old or janky, you might pay 65%. If it was a brand new practice, maybe the doctor didn't make it or whatever, he didn't want to be an owner anymore, you might pay 75% because everything's really new and swanky. But that number, 70 as a base number, pretty much worked for years, for decades. It worked. So now what's happening now? So I'm going to get into a little bit of terminology. Bear with me, but this is, I think, I wouldn't do it if I didn't think it would be important for you to understand. Okay. And many of you may, but let's just throw this out. Most DSOs work off of what's called a captured DSO model, captured DSO, meaning they're going to come in because state laws vary. Okay. Some states, it has to be a dentist owning a dental practice. In other states, I think there's 3 in the US where you can be a non-dentist and own a dental practice. I think it's Pennsylvania, Arizona, and I forget the other. I might be wrong. Look at the Dental Practice Acts yourself just to be sure. But anyway, for a captured DSO, the DSO walks in and they buy all the non-clinical assets, okay? The chairs, they take the employees, the equipment that a non-clinician would be allowed to own. They own all of that. And then the charts are owned by a doctor, because a doctor in most states dentist has to own a dental practice, or at least the dental charts, because the idea is a non-dental corporation can't have any influence over patient treatment, right? Okay. So they'll walk up to a practice that's doing, and also I should mention this, usually the DSO target practice, because they can't really scale, is going to be a practice of some, productivity. It's going to be doing at least 1.2 million a year, if not 2 million, 3 million, etc. They're not going to buy the offices doing 300,000 and 500,000 a year because they don't scale. I talked about this in last week's episode. Anyway, so they come in and they buy this practice. Here's a practice doing $2 million, but how do they buy it? Do they do the 70% model? Well, no, they don't. They have to offer more because in a lot of cases, if you have a practice doing $2 million a year, and let's say this whole idea of paying more than 70% did not exist. And let's say I'm a doctor who wants to take over your $2 million a year practice. Well, I'm going to pay $1.4 million on the 70% model, buy your practice. I'm going to keep you on for a transition period. And then most likely I'm going to want you to move on. Maybe you'll stay on as an associate for a little while, but it gets a little weird. You're the old owner and I'm the new owner and people are still asking you, the staff are still coming to you. It gets a little strange. I got to put my own mark on the place. So how long am I going to want you to stick around? Maybe 6 months? Not long. But with the DSO model, I'm going to come in and buy your practice doing $2 million a year. And I want you to stick around for 5 years. You're going to keep the place going. And I'm even seeing the trend with a lot of these DSOs, and you've probably seen it if you know anything about this, where, it used to be they had a lot more control over the economics of the practice. In some cases, you have DSOs buying practices where it's like, just keep doing what you were doing. You manage the practice, you ran it, I bought it, here's some money, you keep doing what you're doing and keep me some profit coming. Okay. But how are they calculating what they're paying for this $2 million practice since they're not paying 70%? Well, they're offering a multiple, and I'll explain this, of EBITDA. What's EBITDA? EBITDA. It's earnings before interest, taxes, depreciation, and amortization. Okay. To keep this simple, it's basically an alternate. There's a great definition for it. I'll put the link on the episode webpage on Investopedia, but it's basically an alternate measure of profitability to net income. It attempts to represent cash profit generated by the company's operations. Okay, think with it like profit, but it's not exactly profit. It's kind of like profit, okay? And just so we're all clear on what this means, so it's how much you earn before interest, taxes, depreciation, which you probably know what that is if you own a practice. Your larger equipment depreciates over years and you get to take it as a tax break. Amortization is sort of like depreciation, but usually with things like intellectual property, okay? So basically they're paying a multiple of, again, EBITDA, but let's call it profit for simplicity's sake. Again, it's not exactly the same, but just to make it easy. So how would this look? We have a dental practice collecting $2 million a year. All right. With a profit of, let's say, $600,000 a year, the overhead 70%. So the net, the profit is $600,000. All right. So the old way that practice would be valued is it's $2 million last year. You get $1.4 million. Well, now the new way with a DSO is they're going to give you a 5x multiple. This is the multiple of your EBITDA. Okay. They're going to pay 5 times your last year's EBITDA, which was $600,000, your profit. Okay. Again, not exactly profit. I'll stop saying that, but you get the idea. So they're going to pay you $3 million for this office. Well, the old way you get $1.4 million. The new way you get $3 million. But doc, I need you to stick around for 5 years. Now, just basic economics, if you think about this, and you'll get paid for when you stick around for 5 years as an associate, okay? Basic economics, okay, do you want to take $1.4 million for this practice or $3 million? I mean, come on. It's a pretty simple, I wouldn't fault anybody for taking the $3 million. It's unless they really got to get out of Dodge for some reason, they want to leave town and move to another state, they're going to take the $3 million. They also know where they're going to be for the next 2 to 5 years. So usually the way the DSO will structure this is they're going to take the $3 million they're going to give you. They'll give you, some DSOs do it differently than others, but let's say they're going to give you 80% of it now, and they're going to leave you with 20% of the practice. So they're going to buy 80% of your practice for, $3 million is the valuation of the practice. They're going to give you 80% of that, or $2.4 million cash right now. You still own 20% of the practice. And then after you've, been there for 4 or 5 years, assuming the numbers don't crash, they stay about the same or go up, you're going to get paid the balance of your buyout, the other $600,000 that you are owed. Okay. So we have private buyer, you're getting 70%. You get to leave probably within a matter of a few months. DSO buyer, you're going to get considerably more money, but you got to stick around for a while. They may leave it where you own part of the practice, and then they're going to finish buying you out 2 to 5 years later. Now, I started this off by saying DSOs are overpaying for practices. Well, I think they are, because that 70% model worked for decades. It worked. It was a workable model. And there's a number of different reasons why it worked. The first of which is, that multiple. They're paying you 5x EBITDA, right? 5 times that multiple. Well, depending on the business, that multiple changes. Okay. And part of what affects that multiple, and again, I'm not giving you exact numbers here or whatever, but a lot of it has to do with how integral the owner of the business is to the business. So normally, if the owner is the face of the business, it's Dr. Smith's office, you're not usually going to pay more than 3 times EBITDA, because if that owner leaves, you're in trouble. But let's say I own a supermarket, Jeff's Supermarket. We don't even call it Jeff's Supermarket. It's, Value Supermarket. You don't even know who I am. You have no idea. I just happen to own the supermarket. I decide I'm going to sell it to somebody. I'm going to get a higher multiple on my EBITDA because me leaving from an outward facing perspective, as far as the business is concerned, doesn't make a difference. Nobody knew who I was in the first place. I just happened to own the supermarket. So I'm going to get a 5X or a 6X my profit or EBITDA, okay? Versus Dr. Smith is going to only get 3. That's the normal way this is done in the business world, okay? But right now what's happening is you're seeing 5X. I've seen 7X, right, for these practices. So they are overpaying. Now, look, if you sold to a DSO and you got 5 or 7X your EBITDA and you walked away with, a nice check compared to what you would have got if you did it as a private transaction, I am not judging you. I am not hating on you at all. Look, if someone came up to me, my car's 3.5 years old. They came up to me and they said, I want to pay, because, cars depreciate like crazy, right? The second you drive it off the lot. If someone came up to me and was going to pay me full price for what I paid for the car, I mean, the first question I would have is like, you must really want this car, don't you? And then I would go, are you sure? And if they said, yep, I'm going to give you a check right now, of course I'm going to sell the car for that because, I made sure I wasn't doing anything wrong and they really understood. The car's 3 years old. Yes. Okay, cool. Fine. Give me the money. I'm not stupid. There's nothing wrong with it. If you got paid, great. There's nothing wrong with that. But what happens? Let's look at how this affects, like what occurs with this DSO after they've bought this practice. Now, again, we're a podcast, so we'll keep this math really simple because you might be driving in a car listening to it. But let's say it's a DSO and they have 20 practices that were worth $5 million, that they paid $5 million each for. Okay? 20 practices, $5 million. They all had an EBITDA of $1 million each, profit of $1 million each, right? Which is why they paid $5 million for those practices, right? Okay, so they got 20 practices that they paid $5 million for. They each make $1 million profit, and they got 20, so they have a $20 million EBITDA. Okay, so there's a few things that happens when this ends up on the DSO's books. And look, and if this is stuff that you're not into, I apologize. I just want to make sure I get this data out there. First thing that happens is they now have a business with 20 practices worth $5 million each. That's a $100 million business. And their profit, their EBITDA is $20 million, right? Well, because they were a business of that size, this is another thing that affects the multiple they would get if they were to sell it. They could sell parts of that business at a 10 or 12 or 14, really depends on who the buyer is, multiple of their EBITDA. You guys get that? So you sold it for 5. Well, if they took all their practices together in their portfolio of practices, right, they're going to get a higher multiple than that because it's a bigger business. The business is worth 100 mil just in assets. And now if they were to sell it, their profit's 20 mil, they might get, a 12x multiple. They might get $240 million for this business. All right. So they go and sell 60% or 80% or whatever percent of this DSO, or they get an investor, which is a hedge fund, right? The hedge fund buys 60% of the DSO. They're paying a 12x multiple. 60% of this $240 million business now, which it's valued at, is $180 million. So the original owners of this DSO, keep in mind, they only paid $100 million for everything in it, but now the business is worth $240. They get $180 to sell 60% of their shares, right? So they get cash. They're in great shape, right? They get to, they get some money. And they could continue selling more and more and eventually walk away, which I'll get into in a second. And maybe they have to stay on as executives for a bit or whatever. But also don't forget the way these groups work is with a lot of debt. So, you've got $100 million of practices on your books. Well, you can go get more debt now too, can't you? All right. So then eventually the original owners sell the rest of it to, a hedge fund, private equity or whatever, right? And, they get to walk away, the original people who were in, because they work at the same conditions you worked under. You had to stay for 5 years. They have to stay for a few years. Well, here's the other thing. Hedge funds, private equity generally don't hold on to assets for longer than 3 to 5 years. That's the usual churn rate, the time, when they get rid of them and sell them to something else. So, this hedge fund owns the majority of this DSO, right? And then eventually the DSO is sold to a, pension fund for some union for teachers or this or that or whatever, right? But now, remember, time is ticking by as this is all going on. And these places have all they've been overvalued. Again, I'm not hating on you if you got paid this much, but they're overvalued. Maybe the original owner doctors start to walk away and it's left with a bunch of associates. The revenues go down. The underlying assets that people paid all this money for are now worth less. Okay. But the original owners who bought all those assets are gone. They're now owned by this DSO is now owned by so-and-so pension fund. So they're the ones left holding the bag. So a couple things happen at that point. And I know this number gets less and less every year, but I always ask this question when I'm in a seminar, if this comes up, is were you working or were you in the workforce during the 2008, 2009, we I guess, lovingly call it the great financial crisis. I'm joking about the lovingly part, but the great financial crisis, the real estate crash and meltdown of 08, 09. Well, what happened? A lot of these houses were overvalued. There was a real estate bubble. Then when they got marked back to their actual value, the market crashed and it affected a lot of other things. Well, you have a similar thing, in my opinion, going on with some of these DSOs. They're overpaying for assets, but eventually someone gets left holding the bag, but usually not the person who bought it all in the first place. So I buy a house, I spend $300 on that house. The market's going crazy. That house is now worth $800,000. I sell it to you. I get my $800,000. I paid $300. I got $500,000. I'm now buying another house or somewhere else. Well, now the market crashes. That house is now worth $325. Who's the one who's in trouble? Not me. I got my money and walked away. You are. Okay. But then what that does to the psyche of market participants at that point is you start to go, well, I'm going to be a little bit more careful. Like if you're in that situation, you're 500,000 underwater in your house, you're going to go, next time I buy a house, I'm going to be a little bit more careful. And that's what's funny is you don't see that real estate bubble now like you saw back in 08, 09. I know real estate prices have gone up, but not the same way they did back then in 06, 7, 8 that led up to 08, 09 because people remember. Well, the same thing happens. If you have eventually some spectacular issues with some of these DSOs over the next 5, 6 years, that will scare future investment into that type of growth because look what happened to those guys last time. So that's reason number 3. And I hope I didn't get too complex on that. But if you have questions, you can always email me, jeffb@mgeonline.com. And I didn't get into all the gory details about it because it really doesn't translate well on a podcast. And, so whatever. Anyway, okay. Point number 4. I mentioned in point number 3, which is the docs that are selling agree to stay around for 5 years at most. Some are 2, some are 3, some are 4. Well, when that's done, then what? Right? So if these offices haven't already had issues with the amount of managed care participation, the inflation, right? What happens when the owner leaves the practice? This is especially if that owner is the primary producer. Well, potentially that practice is going to start to run into economic trouble, and that's going to start to affect the DSO. I mean, look, some owners will stay. For some owners, it's a great deal. I get to stay. I get to work in my old office. I get to call all the shots, but I don't have all the headaches or whatever. But, at least people I know that have sold in a lot of cases are not planning on sticking around after the 5-year obligation is over. They're going to go somewhere else. This was their exit strategy. So what happens then? Well, here's an interesting other anecdote, recent development. So we have a client. It was a client years ago, did the power program. I'm like early 2000s, right? So they had 3 offices. They sold them to a DSO, which fine, right? They're now buying those offices back, okay, for 29 cents on the dollar, okay? So this practice is obviously, we're not in the greatest of shape after this doctor exited, right, when it was at a high level, right? I'm sure that affected the DSO going up the chain at the upper levels or whoever owns the DSO now. But for the client, it worked out great. I mean, think about it for a second. That same example, I sold my car at a premium, twice of what it's worth, and then I get to buy it back at 30 cents on the dollar now. I'm getting it back. It's almost like I never sold the car. I just walk away with cash. And I'm not saying to be motivated by that. That isn't the point. But, lucky for them. I can't fault them for that. You may as well do it. So I think what happens, if you look, so you have this overexpansion, overpaying for practices. Eventually, if these practices start to get into trouble, right, what's going to happen to these offices? Well, someone's got to pick them up. Maybe another DSO, or it could be you if you sold your office, not to get morbid about it, but maybe you'll find yourself in that situation. Maybe you sold and you're into year 2 of year 5. You might be buying your practice back 8 or 9 years from now. Just saying. Anyway, so yeah, that's reason number 4, that owner operator is left. And there's like a little bit of a bonus reason. I'm not going to number it, which has to do with this, we have a possible ban on non-compete clauses that may go into effect later this year. The FTC, Federal Trade Commission, made a ruling that didn't nullify non-competes, but it made them very difficult to enforce. That has not gone into effect yet. They actually expanded. I don't know when some of these federal agencies will make a decision or a ruling, what will happen is they'll have a comment period where people can comment on it. And they actually extended the comment period through April. But if that rule goes into effect, will go into effect in October. So obviously, if you sold your practice and you have equity in the practice or had equity, that non-compete usually has more teeth. Again, I'm not an attorney. Ask your attorney about this. I'm not giving you legal advice, right? But if you have a situation where you have, associates working in DSOs and then there's other practice opportunities, up to now, they've been pretty harsh about that. I've seen doctors in that situation where they wanted to buy a practice or whatever, and they couldn't get away from the DSO. Well, that may also go away. And, again, not to redo last week's episode, but in last week's episode, I was pointing out these just unbelievable amount of opportunities for, the privately practicing dentist in the US right now for the next probably 5 to 8 years. People are going to want to jump at some of these opportunities, so it may be difficult to keep these offices staffed. Then to top it off, you currently have, 35% of dental seniors in 2022 said they were planning on going to work for seniors in dental school were planning to go work for a DSO when they graduated, and passed their boards, right? So what's going to happen to those folks? They're going to end up, some will stick, some won't, because you're going to have a situation where you may end up with some of these offices not doing as well as you think, right? All right. So that's sort of what we see coming. We think that there's a rough road ahead for a lot of these groups. So what am I telling clients? What are we telling MGE clients? Well, a lot of what we're telling clients, I shared in last week's episode. I hate to do that, but I really would listen to it. It really is what's going on in dentistry right now, as far as, trends and number of dentists and things like this. And there's a ton of opportunity. The first thing I would tell you is that if you're in private practice and you're worried about, oh my gosh, the future is DSOs, blah, 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 you're okay. Private practice is going to be just fine. The second thing I would say is if you're in a situation where some DSO wants to pay a ton of money for your practice and you're comfortable with it, and including sticking around, do it. Do what's best for you and for your family. I think that's a good thing, right? Dentistry definitely has a great future, but part of that has to do with, if you're a private practitioner, you need to get out of PPOs. You have to get out of PPOs because, again, that inflation and the lowering of PPO reimbursement is going to affect you. Okay. If you want to know how to get out PPOs, maybe you think it's impossible or whatever. A lot of our clients have done it and are in the process of doing it. It's not as difficult as you think. We do something called a fees and plans analysis. It's free, where we actually go over the PPO participation in your practice and kind of give you some advice on how to drop them. You can find a link to that on the episode webpage, the fees and plans analysis. I would also learn how to sell, as I mentioned earlier, the MGE communications. I have those links on the site. I'm not going to rehash those. All right. Next thing is, if you're a privately practicing dentist, there's going to be a ton of practices on the market over the next 5 to 8 years that are not going to be DSO targets. I would suggest you do multiple practices. Again, I talked about that last week. Now, if you're working for a DSO and you're an associate and you're wondering, what am I going to do in the future? There's never been a better time to open your own office. You got about a 5-year window. Start looking. That would be my suggestion. Obviously, don't don't do anything wrong as far as the DSO is concerned, or you violate your contract or anything like that. But if this is something that you've had as a dream of yours, now is the time to start realizing your dream. I would say the same thing if you're a student. Even if you're in your first year, you still have time to capitalize on this. The future does include, a lot of the future is going to include private practice, and that could be you. Anyway, or, in some cases, if you might have a multiple practice type situation, almost like your own little mini DSO. I think those are cool. We have clients that do that. They have 6, 7, 8 offices, and they have kind of junior partners in these, because it sort of still maintains the spirit of the private practice of dentistry and that relationship with the patient and doing things, right. Not, doing treatment according to what the insurance company says you can and can't do. It's very patient focused, which is really what I think the profession, at least in my opinion, should be about. I don't think I'll have a lot of people disagree with me on that one. Anyway, a little bit of a longer episode, a lot to talk about. I hope I communicated it okay, just because there's a lot of that terminology and financial stuff earlier. That's what we see coming. I hope this helps. It was a little bit different this week. As I said, if you have any questions, again, my email address is jeffb@mgeonline.com. We'll put that on the episode webpage. And if you have any questions about MGE, what we can do for you or about our company, you can find us online at mgeonline.com or call us at 800-640-1140. Folks, have a great week, and we'll see you at the next episode.